Two people, same paycheck, same hospital bill. One of them effectively pays about $11,000 out of pocket over the course of the year. The other pays closer to $16,000. Same bill, same employer, same salary. The gap is one account. An account most people clicked past in open enrollment because it sounded like something from a human resources manual. A tax thing, a medical thing, probably something their HR department explained once in a slide deck and then never mentioned again. That account is the health savings account. And the reason I'm opening this file today isn't to explain what it is in the textbook sense. You can Google the definition. What I want to do is show you what it actually does to your financial system over time if you use it correctly, and what it quietly costs you if you don't. I'm Nora. I look at financial systems for a living, and the case I want to open today is the case of the account hiding in plain sight. Quick note before we get into it, this isn't financial advice or tax advice for your specific situation. It's honest opinion, education, and experience from years working around these systems, meant to help you ask better questions and make more informed decisions for yourself. Your tax picture is your own. Your health situation is your own. Take this as a lens, not a prescription. Okay, let's open the file. The first thing to understand is why this account stays invisible to most people. It's not because the HSA is complicated. The mechanics are actually pretty simple once you understand the structure. It's invisible because of where it lives inside the open enrollment process. Every fall, millions of workers sit down with a benefits packet, a login portal, or a PDF deck from their employer's HR department. They're looking at health insurance options, usually 2 or 3 plans. There's one plan that has a lower monthly premium but a higher deductible. It's usually called a high deductible plan, which frankly is the worst possible marketing name anyone has ever invented for a wealth-building vehicle. It sounds like the risky option, the cheap option, the plan you pick when you're young and healthy and hoping nothing goes wrong. And buried inside the description of that plan is a single bullet point that says something like, eligible for an HSA. Sometimes it's explained. Usually it isn't. The worker looks at the deductible. The number is higher than the other plans. They imagine a scenario where they get hurt or sick and have to pay that full deductible. The other plan feels safer. They pick the other plan. They never open an HSA, and they move on with their year. This happens to a lot of people who could reasonably afford to carry the higher deductible. Not all of them, but a meaningful share of the workforce picks the safer feeling option without ever understanding what they left on the table. And what they left on the table is the only account in the entire tax code that gives you 3 separate tax advantages at the same time. Let me explain what that actually means. To understand why 3 tax advantages matters, you need to quickly compare the 3 main tax-advantaged accounts most workers have access to. The 401k is a pre-tax account. You put money in before income tax, which lowers your taxable income today. The money grows without being taxed every year while it stays inside the account. And then when you take it out in retirement, you pay ordinary income tax on the withdrawals. So the 401k gives you a powerful deal. Deduction now, tax-deferred growth, tax bill later. The Roth IRA is an after-tax account. You put in money that's already been taxed. The money grows without being taxed every year while it stays inside the account. And when you take it out properly in retirement, you pay nothing on the qualified withdrawal. That's also a powerful deal. Tax bill now, tax-free growth, tax-free qualified withdrawal later. The HSA does something neither of those accounts does. You put in money before it gets taxed, which lowers your taxable income today. If you contribute through payroll, you avoid FICA taxes too, which a regular Roth or IRA contribution doesn't do. The money grows without being taxed every year. And when you use it for qualified medical expenses, which you will have because everyone eventually has medical expenses, you take it out tax-free. 3 separate tax events, 3 separate advantages. None of them requires you to pay. That's not possible with any other account in the standard toolkit. The 401k saves you on the way in, costs you on the way out. The Roth costs you on the way in, saves you on the way out. The HSA saves you on the way in, during growth, and on the way out, as long as you're using it for what it's designed for. Now, here's the part where I want to slow down, because this is where the case gets interesting. If you contribute the maximum HSA amount as a single person in 2026, that's $4,400. If you're covering a family, it's $8,750. If you're making, say, a $70,000 salary and you're in the 22% federal tax bracket, maxing an HSA and keeping it invested instead of spending it saves you somewhere around $1,300 in combined federal income and payroll taxes in that single year, before any state tax benefit. The exact number depends on your payroll setup, your state, and your tax situation, but the direction is not subtle. Do that for 5 years, that's $4,000 to $5,000 in tax savings that stayed in your pocket, not counting what the invested money did in the market during those 5 years. Now compare that to someone on the same salary with the same health insurance costs, same employer, same hospital bills, who picked the lower deductible plan instead. They're paying a higher monthly premium, they don't have an HSA, their out-of-pocket medical costs are coming from after-tax money. Over the same 5 years, the gap in their household finances can easily reach $5,000 or more, just from the tax treatment difference. That's the gap, and it compounds. But here's the part most HSA explainers skip, which is why I want to spend real time on it. The majority of people who do have an HSA aren't using it as a wealth-building vehicle. They're using it like a medical debit card. Here's how that version of the story usually goes. They open the HSA, they contribute some amount, maybe a few $100s, maybe enough to cover a copay or two. They have a doctor visit. They pay with the HSA card because it's right there in their wallet. They have a prescription filled. They use the card again. At the end of the year, the balance is roughly zero. They start the next year from scratch. The account never grows, it never compounds. It's functionally just a more complicated checking account with some paperwork attached. That's not wrong exactly. Using the HSA for medical expenses is what it's designed to do. You're not breaking any rules. But you're also leaving the most powerful feature of the account completely untouched. The most powerful feature of an HSA is that you are not required to use the money in the year you earn it. There is no use it or lose it rule. The balance rolls over forever. You can contribute money in 2026, hold it untouched for 20 years, and then reimburse yourself for a medical expense you paid out of pocket in 2026, as long as you kept the receipt and the expense was incurred after the account was opened. That's not a workaround. That's literally how the account works. Which means the highest value version of an HSA strategy looks like this. You contribute the maximum every year, you invest the money inside the HSA in a low-cost index fund, and when you have a medical expense, you pay it out of pocket if you can, keep the receipt, and let the HSA balance keep growing. You're essentially running a growing, tax-sheltered investment account that also has an unlimited, permanent medical reimbursement balance accumulating in the background. The longer you hold the receipts without claiming them, the more that invested money has grown. You've turned a near-term medical expense into a future tax-free withdrawal from an account that's been compounding in the market for years. Most people never find out that receipt-holding strategy is an option. They think an HSA is a pre-funded debit card. It can be, but it can also be a long-duration compounding account with one of the cleanest tax structures in the code. Let me walk through the practical mechanics so this doesn't stay abstract. Step 1 is contribution. In 2026, a single person can contribute $4,400 to an HSA. A family can contribute $8,750. If you're 55 or older, there's a $1,000 catch-up contribution on top of that. One detail people miss: employer money counts toward that same annual limit. If your employer drops in $500 or $1,000, that's great, but it reduces how much room you have left for your own contributions. And if you're married and both spouses are 55 or older, each spouse needs their own HSA to make their own catch-up contribution. The contribution usually has to happen while you're covered by an HSA-eligible health plan, which is why open enrollment matters so much. If your employer offers an HDDP option, check the HSA eligibility, because plan labels and plan rules do not always communicate the financial meaning clearly. Your HR team or benefits administrator can confirm the eligibility. Contributing through payroll is meaningfully better than contributing on your own, because payroll HSA contributions avoid FICA taxes, which standard IRA contributions don't. That's an extra 7.65% savings on Social Security and Medicare taxes, which sounds small until you do the math on the full contribution over a few years. You can also usually contribute on your own up to the tax filing deadline for that year, but the payroll tax advantage only happens through payroll. Step 2 is investment. Most HSA providers have a default sweep into a cash-like account, which earns almost nothing. You usually need to actively choose to invest the balance. The steps vary by provider, but it typically means logging into your HSA account and choosing an investment option, the same way you would inside a 401k. Look for a low-cost total market index fund. If your provider doesn't offer good investment options, you may be able to transfer the HSA to a different provider who does. Step 3 is the holding decision. Every time you have a qualified medical expense, you have a choice. Pay it with the HSA card and get the tax-free withdrawal now, or pay it out of pocket, keep the receipt with the date and amount, and preserve the invested balance inside the HSA. There's no deadline on claiming the reimbursement. You can claim it 3 months later or 30 years later. But the record keeping has to be real. Date, provider, amount, proof that you paid it, and proof that the expense happened after the HSA existed. This strategy is elegant right up until someone has 20 years of bad receipts in a shoebox. Step 4 is the age 65 pivot. Once you turn 65, the HSA changes its behavior. You can still take money out tax-free for qualified medical expenses, same as always, but you can also take money out for any reason at all, the same way you would from a traditional 401k. You pay ordinary income tax on non-medical withdrawals, no penalty. Before 65, that same non-medical withdrawal is generally a bad move because you get hit with ordinary income tax plus a 20% penalty. The account becomes a second IRA with a better contribution timeline and a more flexible withdrawal path once you're past 65. When you add those 4 steps together, what you have is an account that works well as a near-term medical buffer, works better as a midterm tax shelter, and works extremely well as a long-term retirement vehicle, especially for healthcare costs, which tend to be one of the largest and most unpredictable expenses in retirement. Now, let's talk about why this is a 2026 story, not just an evergreen account explainer. For years, the HSA rules were narrower than a lot of people realized. You generally needed a plan that fit the classic high-deductible health plan definition. For 2026, the IRS inflation-adjusted HDHP floor is a deductible of at least $1,700 for self-only coverage or $3,400 for family coverage, with out-of-pocket maximums of $8,500 for self-only coverage or $17,000 for family coverage. Those numbers matter because the HSA is not just an account you can open because you feel like it. The health plan has to qualify, but the rulebook has widened, and in 2026, that change becomes much more visible. The first change is that beginning January 1, 2026, bronze and catastrophic individual market plans get treated as HSA compatible in a way that can bring more households into the HSA system, even if the plan does not meet the usual HDDP deductible and out-of-pocket tests. IRS also clarified that the plan does not have to be purchased through an exchange to get that treatment. That matters for freelancers, contractors, early retirees, and people buying their own coverage, because a lot of them used to assume the HSA door was closed unless the plan had the exact right label. The second change is telehealth. This one was not brand new in 2026. The IRS guidance made clear that the permanent telehealth rule applies for plan years beginning on or after January 1, 2025. In plain English, certain telehealth and remote care services can be offered before the deductible is met without blowing up HSA eligibility. That sounds boring until you realize what it fixes. A lot of modern health plans include some kind of virtual care access, and under older rules, pre-deductible coverage could create eligibility problems. The permanent treatment makes the account easier to pair with how healthcare actually works now. The third change is direct primary care. Beginning in 2026, certain direct primary care arrangements no longer automatically knock someone out of HSA eligibility, and HSA dollars may be usable for qualifying periodic direct primary care fees. Again, that is not a reason to rush into a plan you do not understand. It is a reason to realize that the HSA rulebook is expanding toward the way more people actually buy care. And this is the part that makes the episode worth doing now. The old mental model was HSA equals high deductible workplace plan, probably only relevant if your employer handed you one. The newer reality is broader. More people may be eligible, more plans may fit, and more care models may coexist with the account. That does not mean everyone should use it. It means more people should at least know enough to run the math before they click past the account. I want to be honest about the caveats because this isn't a universally correct strategy for everyone, and I'd rather you understand the trade-offs than just hear the upside. The biggest constraint is that you need to be eligible to contribute. For many workers, that still means being covered by an HSA-eligible high-deductible health plan. If you have ongoing, expensive medical needs, a chronic condition, or a family member who requires frequent care, the math on a high deductible plan might not work in your favor. A lower deductible plan with a higher premium might actually cost less in total once you account for predictable medical expenses. This is a calculation you should actually run for your own situation, not one to eyeball from a YouTube video. The second constraint is that other health plan coverage can quietly break HSA eligibility. A general purpose FSA or HRA can disqualify you, even if you are also enrolled in an HD-PHP. A limited purpose dental and vision FSA is usually a different story, but the point is this. A lot of people think the HD-HP alone settles the question, and it doesn't. Eligibility is a full system question. The third constraint is that the receipt-holding strategy requires you to have enough cash flow to cover medical expenses out of pocket. If you can't comfortably pay a $500 urgent care visit without using the HSA, then the strategy of letting the HSA compound isn't realistic for your situation right now. You use the HSA as a buffer first. The long game version comes later. The fourth caveat is that qualified medical expenses still have rules. The category is broad, but it is not unlimited. Telehealth access, direct primary care arrangements, prescriptions, dental care, vision care, Medicare premiums later in life, and over-the-counter items each have their own rules and limits. You want the current IRS guidance or a tax professional for the exact edge cases, because a confident guess is not a receipt. The fifth thing I want to name is that HSA contribution eligibility ends the month you enroll in Medicare. If you're approaching 65 and planning to enroll in Medicare, you need to stop contributing to the HSA before that enrollment kicks in. Otherwise, you'll owe back taxes on those late contributions. This one catches people off guard, especially if they're still working with employer-sponsored coverage and delaying Medicare. And one more detail for people who like clean tax rules. HSA treatment is not perfectly identical in every state. California and New Jersey, for example, have historically not followed the federal HSA tax treatment the same way. Federally, the account is powerful. State treatment can be messier. That does not kill the strategy, but it does mean your own state return matters. None of these caveats make the HSA less powerful. They just define the parameters of who it works best for and when. And those parameters cover a significant portion of the American workforce, which is why this account's underuse is such a consistent pattern. Let me close with the dollar picture, because that's what makes this case concrete. Imagine a worker who's 32 years old, makes $68,000 a year, and just enrolled in an HDHP for the first time.
They max out the HSA at $4,400 in year one and invest it entirely in a low-cost total market index fund. They do this every year for the next 28 years, until they turn 60. They pay all their medical expenses out of pocket and hold every receipt.
At historical average real equity returns, that account balance at 60 would be somewhere in the range of $400,000 to $500,000. The exact number depends heavily on market timing, the specific index returns over that period, HSA contribution limit adjustments over the years, and a lot of variables I can't predict with any precision. What I can say is that the order of magnitude is real. A maxed, invested, held HSA over a long working career produces a material retirement account with a better tax structure than a traditional 401k or Roth for anyone who will have medical expenses in retirement, which is essentially everyone. Even on a much shorter horizon, the picture is meaningful. Same worker, same contributions, same investment assumption, but just 10 years instead of 28. The balance is somewhere around $60,000 to $75,000, and the total tax savings on contributions alone is somewhere around $10,000 to $12,000 in federal taxes avoided, again, not counting the market growth. And notice what makes this different from the normal retirement account conversation.
With a traditional 401k, the government gives you the deduction now, but it wants ordinary income tax later. With a Roth, the government takes the tax now and gives you the tax-free withdrawal later. Both are useful, both can be excellent, but they each pick a side of the tax timeline. The HSA is stranger.
If the money eventually reimburses qualified medical expenses, the tax never shows up in the same way. Not on the way in, not during the growth, not on the way out. That is why more tax-free than a Roth is not just a catchy title. A Roth is tax-free on the growth and qualified retirement withdrawal, but the contribution started as after-tax money. An HSA contribution, when used properly, can avoid tax before the dollar ever enters the account and still come out tax-free later. The dollar gets a cleaner path through the system. That cleaner path is the whole case. The account is not magic. It will not fix a bad health plan choice. It will not make a high deductible harmless.
It will not make someone with thin cash flow magically able to pay medical bills out of pocket while investing the HSA balance. But for the person whose health plan, cash flow, and risk tolerance actually fit, it is one of the rare places where the tax code gives regular people a real structural advantage. And the system hides that advantage behind the most boring name possible. Compare that to the version of this person who picked the lower deductible plan every year, contributed nothing to an HSA, and paid medical expenses from after-tax money. The dollar gap between those two households, compounded over 10 or 20 years, is not a rounding error. It's a meaningful chunk of the wealth gap that shows up between otherwise similar households in the same income bracket.
That's the case. The account isn't a medical benefit. It's a financial system dressed up in HR language. And the first step to using it correctly is just recognizing what it actually is. If you're enrolled in an HDSP right now and you haven't opened an HSA, that's the first move. Check with your employer, because a lot of them offer a contribution match or a contribution seed for the HSA, the same way they match 401k contributions. And that's money sitting unclaimed. Just remember that employer money still counts toward your annual limit. If your employer doesn't offer an HSA through payroll, you can open one directly at several major providers and make contributions on your own. If you have an HSA that's sitting in a cash sweep doing nothing, log in, look for the investment options, and start treating it the way you treat a 401k. The default cash account is not the point of the account. And if you're in an HSA and have been paying every medical expense with the card, start keeping receipts for anything you pay out of pocket instead. Date, amount, and a description. You don't need to submit them now. You're just building the reimbursement reserve for when you want it.
The long game version of this account takes a few deliberate moves up front and then gets very simple very fast. Contribute, invest, pay out of pocket when you can, hold the receipts, and let the account run. That's the playbook. It's not complicated. It's just hidden inside a name that sounds like a tax form. I'm Nora. I'll see you in the next case.